we're going to likely see a major correction until at least the second half of 2027, if not 2028. Debt explosion with AI is also motivated by the need to just keep the debt system alive. It's existential. Bitcoin is not done going down, I'm afraid. I absolutely expect Bitcoin to be below 50.
I'm pleased to welcome back to the show Richard Smith, Executive Director of the Foundation for the Study of Cycles. Richard was on the show last in December 2025, and he had correctly called the top in many assets, including Bitcoin. He said that Bitcoin and other assets would see a bubble pop in 2026, and he was correct. So how far along are we in this bubble pop? Do we have more room to the downside to go? Or is this the bottom? We're going to find out. Richard's going to reveal the next phase of the cycle and what global liquidity conditions will tell us about the direction of markets into the end of 2026 and perhaps beyond. Traders are already placing predictions on how low Bitcoin will go. I look at the prediction markets as a good gauge of sentiment and what people are currently looking at and thinking. For example, on Kalshi, there's currently a 61% chance that traders think that Bitcoin will end up below 50,000 by year end. Additionally, traders think there is a 75% chance that gold will outperform the dollar index by this year. Now, Richard agrees with one of these trades. We're going to find out which one that is. This video is sponsored by Kalshi. It's the largest prediction market in the United States. Unlike a sports book, you're trading peer-to-peer on real-world events, from economic data to political outcomes, and the price moves on public opinion, not a house. Go to the link in the description down below or scan the QR code here to get started, and new users who use my code LIN, L-I-N, can get $10 when you trade $10. And again, I reference these two trades. Those are just two of many trades you can participate in, and we're just going to talk about both the dollar and gold and Bitcoin today. Welcome back to the show, Richard. Good to see you.
Thanks for having me, David. Happy to be here.
Let's start from talking about the cycle that we examined back in December 2025 and how that's played out over the course of 2026. You had called for the bubble to pop. Let's just re-examine why that is, why that turned out to be the cycle top.
I think that the big bubble that's going on is the liquidity cycle, and I introduced you to Michael Howell, who I believe you had on your show. He talks about really does outstanding work, the 65-month liquidity cycle. And in general, we see liquidity tightening, and we see assets moving out of the financial sector and into the real economy, which sounds paradoxical. But the real economy actually kind of lags the markets and the financial sector. And we go through these cycles that have, since the great global financial crisis, have largely been debt refinancing cycles. And they tend to last about 65 months. And so the big money flows that are happening right now are kind of out of financial assets, which got overextended, and into real economy assets, including things like energy and oil, et cetera. And I think we see a lot of conflict going on or surfacing. It's always been there, but it's been more under the surface. But we see more conflict surfacing over real world resources and real world relationships, et cetera. And this is a classic part of the liquidity cycle where you see stresses from the financial sector basically getting overextended. And it's not rocket science to predict this stuff, but I think that we're going to continue to see inflation be sticky, if not a problem, as real world assets get repriced and people start realizing that everything isn't in ones and zeros, everything isn't just bits, that there actually are, real resources that are needed to live and survive and thrive, right? So I think all of that's going on. I think that's impacted gold. I think it's impacted Bitcoin. I think I probably said back then, because I've been saying for a while, that we'd be seeing a major rally in the US dollar. And I think that has started to get underway. So especially things that are priced in dollars, right, are going to be seeing price pressure. And in general, I think one of the things, so we just finished up our annual conference in New York City, Cycles in the City, really an unbelievable, incredible gathering where there's only 100 people in the room, but 20 of the people are world-class speakers, including Michael Howell, Larry Williams, Jake Bernstein, Harry Dent, just an incredible list of speakers. Bill Cerubi, one of my favorites, and really putting our heads together about, what's going on with cycles in our world and our economy. And there was a pretty robust consensus that this last half of the decade is absolutely going to be a challenging time. And one of the very interesting things from a cycles perspective, David, is that we are 54 years, which is the Kondratiev cycle, away from 1972, which was the big US dollar reset back then, right? With Nixon taking us off the gold standard and Bretton Woods and all that. So we are literally, one Kondratiev cycle from that seminal event of the past 55 years. And here we are again, having a global debate over the role of the US dollar and US treasuries in the global economy, and whether or not, the world wants to keep doing that for another half century, or whether or not there's going to be some new system. So I think that's a big part of what's driving things and what we're witnessing in real time right now.
Okay, let's jump straight into an asset. I want to come back to global liquidity in just a minute because that supports the thesis of how low and high things will get. How low will Bitcoin get this year? This is always on people's minds. If you're in any asset, how low or high will something get by the end of the year? That ultimately affects what you do. So this is from Kalshi. It's a prediction market. Traders are predicting with a 61% certainty that Bitcoin will end below 50,000. 61% isn't very high. So just higher than 50-50 chance that people are a little more bearish than bullish right now. Your thoughts? Currently, we're at 60,000.
Well, we've had a pretty reliable forecast of Bitcoin for several years now, and there's typically kind of a 5-wave cycle of 200 days to the upside and a 3-wave cycle of 200 days to the downside, 200 days each, right? So I think that Bitcoin is not done going down, I'm afraid. And typically these corrections of Bitcoin are in the 75 to 80% range. So if you just take 125 and you go down, 3/4 of that, what does that put you? Somewhere around 30, 35. So I absolutely expect Bitcoin to be below 50. I wish it weren't the case. I've enjoyed Bitcoin, but I don't think Bitcoin's correction is over by any stretch. And I think in general, this move out of financial assets and into real world assets is a big part also of, Bitcoin is kind of the canary in the coal mine for liquidity. And the fact that liquidity is decreasing and is likely to do so for a couple of years doesn't bode well for the near term prospects of Bitcoin.
When you say canary in the coal mine, do you mean it's a leading indicator or coincident indicator?
Yes, I do. Bitcoin is one of the first to benefit and the first to suffer from changes in liquidity.
That ties into my next question. This is from S&P Global. You've done your own analysis. Credit cycle indicators, they believe that the credit cycle indicator from the S&P indicates credit expansion coming into 2026. However, the Middle East war and its effects on energy prices, supply chains, inflation, and financing conditions could reverse the expansionary trend. Here we have a chart showing credit expansion, global credit cycle indicator. They believe it's probably going to reverse sometime soon. And what we've seen in this chart, for example, for the early part of 2026 coincided with what you said to me in late 2025, which is that we're probably going to expect QE. Now, given the events that have happened and transpired in the last couple of months, how do you think credit conditions will change this year going forward?
I think there's going to be an aggressive attempt on the part of Treasury, together with the Fed, to expand credit because it's going to need to be expanded by the Fed and the Treasury because it's going to be tightening in the private sector. So I think that credit is desperately needed, and one of the huge issues is that there is a massive wall of debt that needs to be refinanced over the next 5 years. When the Fed took interest rates down to zero, which, one of the things Michael Howell said at our conference was he was at Solomon Brothers, Solomon Smith Barney back in the day. And Homer's interest rates back to, 4,000 years was the Bible of the place. And never in the history of interest rates in 4,000 years did anybody ever take interest rates below zero. So, of course, all the people who could do so termed out their debt, right? And now that debt wall that needs to be refinanced is dead smack ahead of us. So that creates a big problem, and there's got to be credit flowing in order for that debt to be refinanced. So it's really kind of a do or die situation for Treasury. And, another thing we've talked about, Michael, is how Treasuries, particularly short-term Treasuries, really are the basis, the collateral basis of the global financial system. So that's how trade happens. That's how money flows. Short-term Treasuries are the collateral in the global financial system right now, and that's been how it's been primarily since the global financial crisis. So again, creating those conditions, and I think they are being engineered. I think that is part of what's going on with private credit. I think all the AI data centers, I'm sure I talked about this before, but this whole, debt explosion with AI is also partly motivated by the need to just keep the debt system alive, right? So the debt has gotten so extreme, and the refinancing needs are so great now that machine, it's existential, to keep that machine going. So is it going to be kept going? Yes, I believe it will be kept going.
How can the machine be kept going? How can we continue to expand credit when interest rates are rising all around the world? ECB raised rates, Japan raised rates. The Fed is probably going to be about to raise rates soon this year, according to market expectations. The financial engineering that you talked about is fighting an uphill battle here. How does this work?
Because there is no alternative. It has to be done. So what we can expect is that it will be done, and that we will see sluggishness everywhere else as people spend more money servicing debt. But the debt's not going away, and we don't really, we have to stop and ask ourselves, do we really want the system to crash? Because that would be very painful, right? So that's always a dilemma. But we definitely are in more of a danger zone for something catastrophic happening right now, just from a complex adaptive systems point of view. The system is more brittle right now with the level of debt and the refinancing needs and inflation being on the rise. One of the things we saw from Larry Williams that he shared with us is the incredible correlation between solar flares and inflation. They're highly correlated, and solar flares are forecasted to increase over the next couple of years, and that lines up with the prospect that inflation is likely to increase over the next couple of years too.
Because it has an impact on inflation in farming products? Sorry, it has an impact on weather and agricultural products?
I think that's part of it. That definitely is part of it. And that, again, it kind of gets into the moving out of the financial sector into the real economy needs, including food and energy, right? And having those be disrupted by geomagnetic activity and weather patterns, et cetera. We're in the big AMO, the Atlantic Multi-Decadal Oscillator cycle right now, which also is correlated with some of these things. So there absolutely are kind of global influences that affect all of the globe, and those do tie into markets as well.
So Speaking of debt, this is truly an unprecedented era for America. According to the CBO's February 2026 budget and economic outlook, debt will reach a record 120% of GDP by 2036, which is less than 8 years from now. The CBO projects that debt held by the public will grow by $25 trillion. Meanwhile, deficits will exceed $3 trillion by 2036. To put into perspective, this is now going to be greater than the World War II level of debt to GDP. It's truly unprecedented, and it's the first of its kind in America. How do you even analyze or project what will happen to the economy once debt hits that level? Because there's no point of reference for any point in time in the last 100 years in America.
I think the point of reference we have is Japan, where this has been going on for a while. And I think Japan is a pretty good model for what we'll be seeing in the US. But again, the US has this unique position of still being the world's reserve currency with the dollar, and having treasuries be the collateral foundation of the global financial system. So those are not things that are going to be easily disrupted, because, the US is still largely the cleanest shirt in the dirty laundry, right? And we have a lot of geographic benefits and tax-based benefits, etc. So we still are kind of the most reliable place to have the global financial system be rooted in, but that is absolutely being called into question right now and being competed for, right? And I think that's a big part of what's going on in the Middle East right now is, the petrodollar status and the need to continue to have oil traded in dollars and to preserve that position of the U.S. dollar and the U.S. Treasuries. Scott Bessent just published an interesting op-ed piece in the Wall Street Journal this week. I don't know if you saw that, but saying Trump's geopolitics, I guess, is inspired by Alexander Hamilton. And it was very much about treasuries as statecraft, right? That this is a tool in the United States' arsenal that is going to be, wielded in a different way than it has been over the past 50 years. So those are sea changes that are, there for everyone to see. And it's funny, sea changes with the Strait of Hormuz and everything. But I do think we are going through some sea changes right now, and things are happening that, I haven't seen in my lifetime, and I'm sure you haven't seen in your lifetime either, right? Like the trade routes being, disputed the way that they are right now. That's a huge, you and I have not seen that before.
And by the way, let me just reference what JP Morgan CEO Jamie Dimon said recently last week at a conference. I'll just play this clip real quick, and then we can comment on it together. Take a listen.
It is hard to go to a CFR event these days where Europe doesn't get dumped on, I'm afraid.
But Europe, but this is a serious problem. The GDP of Europe has gone from 90% of America to 70%. And at the current, and our view is it'll probably continue to erode over time because high taxes, I'm not against social safety nets, and we should probably talk about that a little bit too, but they're too high and effective in a lot of countries. They have 100% debt to GDP also, but growing slow is much worse with 100% debt to GDP than growing fast. And they're, kind of anti-business, poor tax structures that stop investment. Capital formation generally drives growth. A lot of that capital is moving here. Like here's some big numbers for you. Our stock exchange is worth, I think, 60, maybe 70 trillion today. Deutsche Börse, 3. The FTSE at UK, 4. The French one, 3. And that is serious stuff. And there's not a deep recognition. So
Okay, is he right though? Maybe there is some aspect of American exceptionalism that will still help the economy grow, albeit the fact that debt to GDP will grow.
I think so. I do think it's, that is absolutely that the U.S. is the cleanest shirt in the dirty laundry argument. It's very compelling. I thought what he said about the middle powers, being Europe is quite telling. And look what's happened to Europe versus the United States. So, we live in a winner-take-all economy right now, and the U.S. Has a lot going for it still. So I do think it will help the U.S. muddle through more, but let's face it, absolutely, debt servicing costs are going to be taking a bigger part of everyone's pie, and that's going to slow down growth. We are not headed into a explosive growth period right now. It's going to be a muddle, and I think there's a number of challenges over the next 5 years, although I don't think that we're going to likely see a major correction until at least the second half of 2027, if not 2028.
This is an interesting outcome here. Annual return DXY versus gold. Traders are overwhelmingly more bullish on gold versus the US dollar index. This year, gold's already come down 35% from its top, though, Richard. What does your cycles analysis tell you about the direction of precious metals?
I think that we're not likely to see a major crash in gold and silver, but I don't think we're likely to see new highs. I think it's probably going to go a little lower from here, and I think the US dollar is going higher. So especially if you are comparing gold to the US dollar, right? There are other economies that look at gold in terms of their currencies, but in terms of the US dollar, I think this bet is flat out wrong, and I would be intrigued by the opportunity to take the other side of that.
Interesting. Now, when you take a look at the fact that these assets have already fallen, you say that Bitcoin is a canary in the coal mine for liquidity conditions. Can the same be said for gold?
A little less so, because gold has a multi-millennial year history of being money. So people are more comfortable with gold as a safe haven than Bitcoin. And I think we certainly saw that over the past couple of years, right? Where all the conditions for Bitcoin to soar really ended up benefiting gold instead, and gold crushed Bitcoin over the last couple of years. So I do think that as we head into these more challenging times, that gold is going to be continue to be preferred over Bitcoin. But I don't think gold is, going to make new highs, and I think it will probably be sideways to down over the next year or so.
The bottom line is, can we expect the momentum?
Right.
Yeah. I think the bottom line is, can we expect the momentum in market bullishness for all asset classes that we saw in 2025 to stall in 2026?
I think so until the end of the year. I think we'll see a decent rally at the end of the year. And then there's the midterm elections cycle for the second half of the presidency, the last 2 years of a 4-year cycle. That's pretty bullish from November through 2027. So that's been a pretty reliable cycle. Hat tip to Bill Cerubi for that one. But I do think that there are some things that make 2027 look not as catastrophic as the debt picture and the increased debt servicing paints. And I think that, we'll probably be sideways to down for a little bit here. But I think by the end of the year in 2027, we'll see new highs in equities.
Okay, good. Thank you very much. Where can we follow your work, Richard?
Cycles.org, and on YouTube we have Cycles TV. So YouTube is a great spot to keep in touch with us. But Cycles.org, and you can sign up to keep in touch with us there if you'll give us your email address.
Okay, I encourage everyone to follow Richard in the links down below. I'll put them in the description. And once again, Richard, thank you for coming back on the show. Richard's one of the guests on my show who have been correct in the direction of his calls for this year. So I think we should all listen to him again. Thank you so much, Richard. Take a look.
Thank you, David.
Yeah, take care for now. We'll talk again soon.
Sounds good.
And thanks for watching. Don't forget to like and subscribe, and use my code LIN, LIN, when you sign up to Kalshi Remember, new users who use my code LIN can get $10 when you trade $10. Link down below in the description or scan the QR code here.